We'll continue with the investment decision chapter. We are at project classification. Project classification. See, this project classification can be divided into two types. This is not necessary to divide, but we will get a better understanding if you divide in two types. So first one is on the basis of firm's existence. When I say firms, it is a company, organization. Firms existence. Second one, on the basis of decision situation. So we can divide into two types. So under this we can have first one, replacement and modernization decision. What is that? Replacement and modernization decisions. See, sometimes you have to modernize, you have to replace the old machines, because some machines, fixed assets, have lifetime. For example, car you are purchasing lots of car, you are in a what taxi business. You cannot use 2010 model now, because it is a 10 years old. You have to replace, you have to modernize your business. uh, you are invested in like a Ola, like a Uber business. You cannot use old, you have to replace. So the replacement and modernization decisions are aimed to improve operating efficiency. That is, day-to-day operations should be run. So in order to run that decisions has to be made. You have to make a new decision, investment decisions, so in order to operate efficiently and to reduce the cost. Generally all types of plant and machinery require replacement, either because of the economic life, because it has a certain life period of the plant and machinery is over, it will get over, because it has a some or it may become technologically outdated. For that also you may require modernization. Let's say Nokia, one of the leading mobile company, but because of they are not technologically updated, they are not replaced their technique or their technology, they are not cope up with the modernization, they are not invested in that particular area, so they collapsed, they become at the bottom of the that industry, mobile industry. So this replacement and modernization decisions is very much required. The former decision is known as a replacement decisions. That is the first one. Second one is modernization decisions. Modernization in the case of technological outdate, replacement in the case of your lifetime useful life of the asset gets over. So in both cases, replacement and modernization decisions are called cost reduction decisions. So that is the first one, that comes under your existence of the firm, depends upon that. Number two, under that, expansion decisions. You are we are Classifying the project, this type of project may require, these types of the projects may require because of this. Expansion decisions, the existing successful firms may experience growth, so in order to grow you have to do expansion, because you may have a demand for a particular product line. In order to experience growth in that demand of their product line, you have to grow. If such firm experience shortage or a delay in the delivery of their products due to inadequate production facility, they may consider proposal to add capacity to existing product line. For example, your maximum capacity of production in a firm or in a factory is 1000 products, let's say 1000 products, but your demand in the market is 1500. Then you have to make your new production capacity of adding 500 units. You have to add some new plants, you have to invest for that 500 plants, so demand is there. So in order to fulfill the demand, you have to do the expansion. That is called expansion decision. Third one, diversification decision. These decisions, diversification means diversifying your business. You are introducing new products. You are in a existing product, you are in a new product line, you are launching a new product line, you are diversifying your business. So these decisions require evaluation and proposal to diversify into new products line, new market. If you are in a southern part of India, you may go to the northern part of India to make a business. So new market, etc., for reducing the risk of failure by dealing in a different products or by operating in a several markets. So that is called diversification decisions. So that is under on the basis of firm's existence. Next comes on the basis of decision situation. Under that, number one is mutually exclusive decision. Mutually exclusive decisions means if two or more alternative proposals are there, okay, two or more alternative proposals are there, that the acceptance of one proposal will exclude all acceptance of all other alternative proposal. If you select A, you have to exclude accepting the B, C, D other proposal. That is called mutually exclusive decision. For example, your firm may say, let's say, considering proposal to install semi-automatic or highly automatic machine. Semi-automatic machine one side, otherwise highly automatic machine. If the firm installs semi-automatic machine, it excludes the acceptance of proposal to install the highly automatic machine. Okay, that is called mutually exclusive decision. Next comes accept, reject decisions. This is a totally independent, not related to certain particular line of business. Entirely different is a option A is a different business, B is an entirely different business. So the accept reject decisions occur when the proposals are independent and do not compete with each other. It is not competing with each other project. Okay, the firm may accept or reject a proposal on the basis of a minimum return on required investment. For example, you want to make a mall in a Mangalore, new mall, shopping mall, or you want to make a hospital. It is a accept or reject decisions. Hospital, you may build a hospital or you may start a shopping mall. So the firm may accept or reject proposal on the basis of minimum return on the required investment. All those proposals which give higher return than certain desired rate of returns are accepted and the rest are rejected. Whichever is the higher return, you will select that one. Last one, contingent decisions. The mean contingent means depend upon on the certain projects. The contingent decisions are dependable proposals. For example, if you investment in a particular place, let's say you are building a huge investment in a particular rural area, but there is a no road, but you have to create a new road. It comes with the contingent. The investment in one proposal requires investment in one or more other proposal. For example, if a company accepts a proposal to set up a factory in a remote area, it may have to invest in infrastructure also. Correct, right? You cannot set up a factory in a remote area without any infrastructure facility, building a roads, houses for employees, etc. These are comes with that setting up of the factory in a remote area. That is called contingent decisions, depend upon the particular proposal. Your main thing is not to build a road, your main investment is not to create a house for employees, but it is depends upon your creating, setting up the factory. So that is called contingent decision. These are the project classification. You may have mandatory investment, that is the first one. Replacement, sorry, modernization. You may have a replacement, expansion, diversification, R&D, miscellaneous project. So you may write generally also, better to write like this type, on the basis of firm's existence, on the basis of decision situation. It gives a clear picture. So this is the project classification of a capital budgeting. Thank you.